your Boulder County update for all of our fun lender friends.
Yep, and we're covering the month of April for 2023, and we're trying to make sense of what's going on in the market, just like everyone else is. I know it's funny out there; things don't seem to be lining up, and what we're really seeing is that it's segmenting out based on price point. And as you guys know, that cost of money is really the number one driver behind the majority of the market. And then we have our nice little luxury area in the top of the market, which is in its own little
Hey, it's Anthony and Tucker. We're here to get
world, but we'll talk about that here in a little bit.
we'll definitely get to that shortly, but take a look at this. So this is detached single family homes, and honestly, they're not doing as well as attached. Attached is doing really well because, well, it's a cheaper, affordable price point, right? But the one thing that's actually kind of surprising is how little listings are coming to market, and that's really keeping our supply fairly low. Now it's fairly consistent. The buyers are out there, but they're only out there as much as they probably have to be. You just don't see a lot of people doing trade-ups, right?
Yeah.
Lots of divorces and marriages and babies, but
It's hard to see the trade up or even the trade down. We're just not seeing those listings hit the market unless it's an absolute must. As we know, you guys did such a good job of refinancing everyone over the last couple of years. Well, everyone has these beautiful 3% mortgages, and they don't want to trade up to a 6.5 or trade down to a 6.5. So we're kind of stuck there on the inventory. But the interesting piece that we'll touch on a little bit as well is the inventory isn't the same across the market. You know, it's very tight in the lower end.
well, here, let's take a look at it. Let's look at it by county because I think this way is a good one. Let me get us out of the way here. All right, so take a look at this. The city of Boulder's inventory over the last 12 months is only up 23% because people in Boulder just won't move if they don't get the price they want. Understandably so. Then you go to places like Erie, or even, I mean, there's a couple places like this, but Erie's a really good example. Erie or Lafayette are actually great examples. Huge rises in inventory. Their sales are down, but honestly, their sales are a lot better than to be expected.
Yeah.
So we have these huge shifts in places. Like, look at Lafayette. Year over year, 140% more inventory. Boulder, 67% more inventory. These markets are not acting at all the same, right?
And this is where we talk about your sub-markets are so important. You know, if you have folks shopping in Boulder County, it's not just the county, what's happening in each of these smaller sub-markets, because they're a different story in each area, different levels of supply, different levels of demand. And that's what we're really seeing play out here is that cost is really playing into a lot of those decisions.
We'll take a look at this. So this is month supply of inventory. And even though everything is changing, everything really is changing, kind of trending in the same direction. So we're seeing rising inventory, right? That's a fact. Well, how much is the problem, right? Look at this one. Month supply of inventory is nearly 2 in almost every market in the area, right? Louisville, being the anomaly, has
And I
the
mean,
lowest supply of inventory.
it's still moving up though. Louisville's still moving up and trending the same direction, just not as fast.
The other crazy part about this is it's still a seller's market in every market in Boulder County, and honestly, by quite a bit, right? We need to be to 4 to 6 months of inventory before we're in balance. I don't know if we're even going to get there,
Yeah.
right?
But
Everything said, maybe we should have, but at this point, listings have
based
slowed
on
down
the
enough.
numbers,
Maybe
we should have. But guess what? Because there's still none of that inventory hitting the market, we're just not seeing that extra inventory sitting. And then, you know, people have to go lower. They have to do more price reductions. And then we'll also be able to tell by price point where the inventory is sitting, because there's some areas we're really tight and there's other areas we're larger. So kind of use this both in per county, or excuse me, per city and submarket, also based on price points. So you can kind of do that, you know, kind of understanding, okay, this price point isn't in Boulder proper. So that means it's the rest of the county that's experiencing this.
Exactly. So let's get over here to the speed of the market, because when you're working with buyers, it's important to understand how much inventory, but how does that really affect them? It means that going into, May or June, we should see a pace of the market be a little bit faster than what we're experiencing now. But look, we're basically at pre-pandemic levels, right? Back to 2019, 2020, that 30 to 30 or 25 days in MLS time on average. Now, the median could be 10, right?
Yeah.
The buttoned up homes, the nice homes, if they won't move in ready, those are going pretty fast. But there is definitely stuff sitting on the market.
That's even that is buttoned up. And there are things that are buttoned up and ready to be moved in. And it's just at a tough price point because folks are having to use a loan. And when you're borrowing $900,000, that's a pretty big monthly mortgage payment.
Yeah.
And you have to bring, whatever those finances, those numbers turn out to be. It's just hard when you're getting to those higher numbers, to borrow that much money at a higher rate when we had it for so cheap for so long.
Well, look at the spread here. Louisville's at 26 days, Superior's at 46 days,
Yeah.
right? Not all markets are created equal, and at this time, it's very obvious that people have preferential treatment as the markets shift. Now, it's shifting different than it ever has before. We're all trying to make a lot of sense of that, but right now, just understand that if you're working with a buyer in a certain market, across the street might be a different market, right? It might not feel the same. It might be different neighborhood to neighborhood. I think that's really important to point out as we're kind of moving forward.
Especially, if you're looking out at Louisville versus Lafayette, you cross 287, you're gonna have a different experience.
Louisville's versus Superior, right? Like
Yeah.
literally across the highway.
Or you cross 36, different story. Cross 287, different story. So it's shifting that fast, even within a couple of a mile or less. Now this is really nice to look at here is our active and sold by price range, and we can really see which parts of the market have been kind of making up our composition of sales and which ones haven't been. And you can really see. Remember last year we had a ton of that $1 to $1.5 million sales. Now look at where the majority of our sales are coming in. That's that 600 to 800 range. And we would have more in the 5 to 6. We just don't have that much inventory in that area. So you can see on the left where our active is and where our solds are. And it's really kind of trending in the sense of we have a lot more action happening in those more affordable price bands. And that's where the hotter competition is. And as we look into that, 1.5, we really, 1.5 up to 2, 1 million up to 2 million, it's a lot slower. There's just not moving as fast because it's either cash, the folks who are using a loan, it's a lot more expensive. So it really is a bigger decision than it was even in the past, in the last few years because of the rates. And then look at the luxury, right? Look at that 3 million plus.
Well, I mean, that's the one that shocks all of us because obviously we know like the world basically discovered Boulder and that was during the pandemic and they kind of blew the lid off the market. But the craziest part is that under 3 million is down by 30+%, over 3+ million, where obviously they're probably not getting loan. We're above last year's numbers, and that is amazing. But look at the inventory level, right? So we'll go to the next slide so you can take a look at this. But the inventory change is unbelievable. And the most inventory shift here is between 2 and 3 million. Granted, every month we seem to see a little bit more inventory at 3+ million coming on the market, but the luxury price points are really struggling, and there's so much inventory. Now, does that mean that the homes won't sell? Absolutely not. So if you're working with a buyer, call it 2 to 2.5 million. Look at that, 23 days in MLS last month, and that just means that if it's buttoned up and it looks right and it's in a good location, it's going to sell remarkably fast because there still are people moving into these, right? But then you could be on the other side of that and look at 2.5 to 3. Some homes that were on the market for 400 days the last month, they skewed the entire average.
And this is what's really interesting too, is we don't have a massive change based on price point for our days in market, where normally we kind of would, but we're not really seeing that. This is probably part of this question we have is what is going on? And as we look over to the left-hand side of this graph with our months supply of inventory, normally it should be a little bit more of a stepping stone, right? We should normally have a little bit more of a gradual buildup.
We shouldn't have a void like we do between.
But we do. It really jumps, and that's the cost of money right there, really playing in.
I agree.
So you can really see how those rates are continuing, now that we have a larger sample size, how they're really playing into the market going forward.
Yeah, I mean, look at 4 to 499. It's the perfect example of this. You got 1 month of inventory. It feels a lot like the Denver metro markets are. They're about a month of inventory. 20 days in MLS, they are flying off the shelf.
Yeah.
And honestly, that's the average. So God only knows what else is going on. But that's a lot of attached product in there, right? There's a lot of attached product at the lower price points. There's a lot of like little tiny homes, in some of these older places.
And then for the detached, that stuff is flying, whether it's buttoned up or not. That stuff is really moving at those price points because it's just so much more attainable.
Exactly. I think there's a lot of opportunity at the higher price points if you wanted to get an investment project or product right now. Let's say you want to do a flip or something, because it's definitely worth reaching out to people. There's just not enough buyers in those pools. So they're starting to see that stacking up. And if it's not buttoned up, it doesn't seem to be selling.
Because there's too much other good inventory on the market.
It does make me wonder, right? Like if you're going to do a flip in those parts of the market, is that a good time to do a flip at $1 million? Maybe not, because you might just have not enough buyer demand. But at the same time, if they're at $1 million and they're buttoned up, they are selling.
When you talk to flippers, you want to have more than one option.
That's a smart idea.
You have good carrying options.
We definitely know that they're selling because you can see it in the days on market.
Yeah.
What we can see is very, very clearly rising inventory.
Yes. And even though we're not getting as much new listings as we would expect, we're still getting more new listings, and that inventory is increasing, and we'll continue to see that for a little bit longer. Now let's jump to our solds. Right.
I moved over to average sales
Oh,
price
sorry.
because
You skipped my
there's
solds.
there's another one to talk about solds that I'd rather talk about, I think, today. But I think the average sales price is something worth having a good conversation about because your year-over-year figure is comparing the absolute peak of the market last April to this April, and it's only down 3%. That being said, they were like 9% over asking price on average last year, right?
Yeah.
So the fact that the entire market, if you look at the TTM percentage change, rose 6% over the course of the last 12 months in maybe one of the hardest real estate markets we've seen in a long time. Now, that's a great sign about the resilience in Boulder County.
And let's just really break that down. So what does that mean to your buyers out there that goes, well, I don't want to buy now. The market might drop. Well, if the market didn't drop when we went from 3 to 6, and we didn't lose a massive amount of valuation and value in our properties, we actually built year over year, right? Because that, as we always say, the TTM, PTTM, trailing 12 months versus previous trailing 12 months. So 1 to 12 months ago versus 13 to 24 months ago, and see what the difference is of those averages. And this is how much we're moving up. We're still moving up at a normal, healthy rate.
Yeah,
right?
It's just like the Colorado average right now.
6%. That's a great, if we're getting 6% appreciation every year as a market, that's a great sign. Now, it's not always equal where that appreciation is.
Yeah,
right?
definitely not equal. So take a look down at the chart at the bottom and you can see, places like Superior, who were dramatically affected by the fire, are the only place that's looking like it's closer to zero, right?
Yeah.
And then you've got places like the city of Boulder, 7% outperforming the county, which honestly shouldn't really surprise anyone. It's a very resilient market. So
Well, and it's a finite area, right? There's still space to go to Longmont. There's still space to go out in Louisville, Lafayette area. There's still places to increase inventory. Boulder's such a finite space. It's going to have always a more forced appreciation just because there's no other option. And it has a zip code, right? People want that zip code. They want to be, hey, I live in Boulder.
Hey, definitely.
Put it on them. But look at Longmont. Longmont didn't see as much appreciation, but it's still clipping along. And it's actually doing better the last 2 years than it was doing about a year ago. So, it's good to see these other markets are still gaining appreciation, maybe at the same rate, but we're all gaining in appreciation. This is where, that value of real estate comes into, and that value of homeownership really comes into people buying and why it's so valuable. As you guys know, that's why you're lenders.
I think the big thing is when you're going to have a conversation with people at average sales price, you definitely want to just talk about history, right? Because it's never a bad time to buy real estate.
Really easy slide here to look at. We can just see we are down in sold volume. When we look over to the right, we're down 22% year to date in residential sales, right? That's what we know. The whole pie just got a little bit smaller. Right now, it's 22% smaller. But the benefit is, the one good thing here is, even though we're not catching up and our year to date's down, by the end of the year, depending on what happens with rates, by September-ish, maybe August, we might see a little relief and we might be able to build back up and catch up in that October, November, December range.
That Q4 is absolutely way lower than we would expect this year.
It's
So
way lower than historical as well, right? We had a nice little bump right after that, school coming into play, and then we saw it really hit us, October, November, December. That Q4 was tough. So hoping, right? This is hoping, but if interest rates move half a point to a point, we can hopefully see those buyers continuing their search process longer. As inventory is out there sitting longer, we have less demand, and rates come a little bit more affordable. Well, hopefully more people either jumping back in or able to pull the trigger and make a decision.
I would even say at the current rate we're going and the current pace we're going, even if interest rates were stable from today all the way through December, you would have a better Q4 than we had this year because that Q4 is real bad, right? So people had that gut reaction pullback. So when we talk about year-to-date numbers, you can talk about how we're going to actually creep back up and get closer to where we were a year ago.
Hopefully we'll be making
nowhere near even again. But even if we got to minus 15% instead of minus 22%, I think that's something reasonable to expect.
And what that means, don't stop. Whatever you're doing, marketing, whatever you're doing for your deal flow, keep it going. This is going to be a marathon year. This isn't a sprint year. Last year was a sprint. This year's a marathon.
So now you can see exactly what that really means for your consumer. I think this is a great slide to show the buyer, like, what does that mean for you, right? What it means for you is if you're shopping in that 400,000 to 500,000 range, there could be bidding wars. Maybe there's a couple of offers, but it's reasonable, right?
Yes.
It's spring, rational behavior. People aren't going wild, but 101.6% is a strong seller's market, right?
Yes.
It's a strong seller's market, and that's fine. And then you get up to other places, well, 3+ million, you're at 95%.
And we can really see that cost of money break point at 800,000 and up. That's really where we kind of see, and detached. Yeah, attached will be a little bit lower. But in detached, you can really see that's where it goes. Okay, as we go up, it gets more buyer favored. Is essentially how you can think of it. After that 800, as we go up in those price bands, it's more in the buyer's favor. So as they're buying a more
right?
expensive
It's
product,
still a seller's market, but it's much less of a seller's
they
market.
have more room.
And the buyers have a little more control.
And then we can really see in that 2 to 2.5 range. Yeah, there's a little bit of a drop there. We had short days on market, so they probably got an offer and took it. They said, we're not going to wait 6 months on the market. Get an offer, take it. And that's where when you're talking to your clients, especially above that 800, put an offer in. Then you at least start the conversation for negotiations, right? If you never put an offer in, tell that agent, hey, even if they reject it, put an offer in. They have to show it to their client, and then we kind of have an idea of where to start. And so that's just somewhere where you can help your folks maybe get a little bit of a deal on a property. Put those offers in, and what they think the right price is. If someone says no, they say no. But some of these sellers, hey, if they get an offer, they might take it because they're not getting the same showings. We're not having 50 people at an open house. We're not having showings literally from the second it's available to the second it's cut off. We don't have that type of activity. So if you get an offer, put an offer. If you like it, if your client likes the house, put an offer and see what happens.
Well, the other thing is too, if you have somebody that's having a hard time getting on your contract right now, chances are there are homes sitting on the market a little bit longer. They may not be perfect and buttoned up, but that's something worth looking at, right? Because no one else is looking at the homes that are stigmatized or sitting on the market too long. So there's a lot of strategies here because this is a very divulgent.
And that's where you can help them save without use a lower down payment, save some of that capital to increase the value or update the kitchen, the bathroom, whatever it is that needs to be done.
All right. Well, you heard it from us first. This is Anthony and Tucker with Land Title. Thanks for always joining us on the Lender Update. We'll catch you next month. Don't forget to like and subscribe to the YouTube channel, and we'll catch you next time.
Sounds good. Bye, everybody.